Hi, everybody. Welcome to this edition of Coach's Playbook. The big dad coach, John Hogue, is out of town right now. So we're joined by I guess we're not young guns, the more like the middle-aged, pushing middle-aged guns, something like that. Anyway, today we're going to talk about why you should be trading futures, which we thought was a good title for it to kind of draw people in. But really, we're going to try and give our sort of objective and our feelings on why, especially if you're day trading, futures represent a better product than, say, stocks or options, which I think would be usually what people would be trading besides that. So first, we wanted to recognize one of our futures traders who has had a really good day today. Mick, you got a trader shout out?
I do. Big shout out to Ephraim Young. He's up $3,400 right now trading the NASDAQ, and had a huge day yesterday. At one point was up 8,500, finished the day up 6,500. You guys know that I love people taking, multiple steps forward, only one step back. It's good money management. It's how you grow an account. So he's up close to 5 figures this week on just 2 days of trading, and, walking away with a large percentage of big equity highs for the day yesterday is, really what people should be doing. And that's how you grow accounts, locking for profits.
Yeah, I'm going to
That's
go out
awesome.
on a limb and say he was probably respecting the trend, right?
Yeah.
Yeah.
Definitely.
And I'm just gonna throw this out there. That is why you trade futures. You can make close to 10 figures in 2 days. So there's the answer. And we can all go home now.
And we're done now.
Yeah.
Good segment,
thanks.
guys.
Visit topsteptrader.com. I'll throw out my LinkedIn. Anyway, but why not to start? Why don't we just talk a little bit about, like, Mick, you were explaining earlier kind of the reasons that you find futures to be an attractive way to trade this.
Yeah, absolutely. I think that the appeal towards futures contracts is because of the leverage that you get. Most contracts in a normal market, you only are required to post 5% margin usually. So you're getting 20-to-1 leverage. That means for every dollar in your account, you get to trade $20 worth of product. So with that leverage, you can start out with a small amount of money and see large profits, definitely large losses. There's that futures disclaimer where you can lose more money than you actually have. But that's what kind of draws people near, especially people who are day trading too. You don't need to put a lot of eggs in one basket to get a lot of bang for your buck if you're right, where that might be the case with stocks or other derivatives.
That's a great point. You think about it right now, the hot stock is Tesla. Everyone's talking Tesla, everyone's watching Tesla. But to get involved in Tesla, you got to have, 4,000, 4 figures. You got to have $1,000 to get in there. And on a good day, you may make 200, but you're putting a lot of money down to make that kind of money. On the flip side, when you look at the future side of things, you don't have to put that 1,000 down to maybe make 200 on a massive day. You can put a couple hundred in now with the accessibilities of the micros accounts too. You can put in smaller amounts of money and you can see those returns start to grow a lot quicker. And you're not having to, run scanners, look for the big movers of the day. You know what products you're going to be trading. You get to understand that product in and of itself. And I've said it a couple times before, but every market's got a heartbeat. And take stocks, for example, you're going to be bouncing around all different kinds of stocks. There's thousands out there. So many different options. And some days they're not going to move. There's not going to be any volume in them, while other ones are. And so you're running these scanners. You're looking for the stock that's going to move that day. And then you first have to dive in and then start to feel how that market is. Where on futures, you get to take the time. You get to learn your product and understand your product. And you hear us say that all the time. Know your product before you even trade. The last thing you want to do is jump in there without knowing it.
Yeah, the same way that we would never recommend that somebody go in and trade every future, down the list from the NASDAQ to, feeder cattle. You got to kind of pick your product. And when you're doing stocks, unless you're just specializing in one thing, which I think is what draws a lot of people to Tesla, for instance, right now, is that you're kind of trying to trade a lot of different feels, different vibes and things like that. JD, I saw you were trying to say something.
Oh yeah, I'm in the same boat as all you guys. I agree with everything you said. Just want to throw it out there. Personally, I am a day trader, so I like the liquidity and the volatility that the futures markets provide. The big contracts like the S&P and maybe even the 10-year note, they trade huge size and volume, and they move. So even if you're wrong a couple times a day, the opportunity is still there to kind of turn it around and make some of that money back. Bids and offers are typically stacked pretty heavily on both sides, so you can't really get into a lot of trouble. I like using market orders every once in a while to get in and out. You're not going to get hurt too bad on slippage the same way that you would with certain stocks. Like Mick was saying, that potential for the 1 to 2% growth every single day without having to risk a whole lot is something that really appeals to me. And also, you can't overlook the cost. Futures are just a little bit cheaper.
Yeah, you can trade with more leverage, and then there's also not the same sort of, even though there's tail risks in anything you'll trade, trading individual stocks, there's a lot more just bad beats, I feel, that can happen with someone tweeting, or the S&P 500 is never going to get acquired by the NASDAQ or something. You know, there's a lot of information out there that's being digested through all of it. I just find the indices a lot easier to trade like that. Another thing is options. So I trade both futures and options. I use options not for day trading. I use them more. They're much better as hedges. I love hedging portfolios or taking longer term plays with options. But I think a lot of people that day trade them kind of trade them the wrong way. You need a ton. The way that people that are trading tons of options every day make money is they're generally, and Dan, you're the options guy, so tell me if I'm going wrong here. They're generally selling the options and staying hedged, and it takes a ton of capital to do that and make money. And you're not going to be able to do that really as a just a retail trader. And so if you're taking directional plays on them, it's just not the most efficient way to do that, because if you want the movement, you're looking at shorter time frames and you're getting burned on the time decay in the options. You're paying a ton of premium. It's sort of a roundabout way to get the exposure you want kind of through futures. What do you think about that, Dan?
Yeah, I mean, so the way I look at it, I come from a professional background when it comes to options. And so options, we had capital. You need a lot of capital. You need to be creating and trading a lot of size with the option side to really start to see the revenue that you want to see. I think that's one of the big advantages to the futures side. You can get in on a retail perspective, coming in a retail account, trading a little bit smaller to make the bigger money that you want to see. Like Jack, like you said, you get into an option, you're buying ones and twos and keeping things really small. Profits aren't going to pay the bills, which a lot of people we know get into futures and retail trading because they want to start paying the bills. They want to transition into a career. Maybe down the road, as you build that capital, you can start thinking about the professional side of options. But from the retail side, the capital is just not there to really create this long-term growth that you want to see.
And you can acquire obviously a ton of leverage through options. The problem I would say for someone that's just has a smaller account that's doing it is that when you're getting that leverage by going way out of the money, what you're really doing is you're buying the positions that they really want to sell you. You're buying those lotto tickets out there to get the leverage, but that's the bread and butter of the people who are on the other side of that trade, right? I mean, they have models as far as probability. You could get lucky. You can get lucky in anything, but you're probably not going to get the returns you want from a longer time frame by buying a bunch of way out of the money options.
Absolutely.
It's better to find leverage elsewhere, I would say, if you're day trading. I still love options. Dan, you love options. We all love options. They're good for certain things.
Absolutely.
Yeah, but futures, I think, is for the directional plays is just like the way to go. Mick, did you want to add something?
I do. I kind of want to circle back to what I was saying about futures versus stocks. With futures, you can trade one contract and it's pretty easy to make or lose $1,000. A 20-point move in the S&P, that's $1,000. Whereas if you were trading, so as far as making or losing $1,000, if you were trying to do that in an equity portfolio, trading stocks, you might need to have a $10,000 position on a certain stock and then see that stock move 10% in a day. So there's not a lot of products out there, I should say, companies out there that are having 10% swings a day. Certainly they're out there, but if you're, strictly an Apple trader or Microsoft, you're not seeing that. So you don't have that opportunity, and that's where you need to really throw a lot more money in to see those similar swings. On the flip side of that, it's pretty easy. there's great things about futures. Leverage is great. You need to manage your money well, because we've also heard plenty of horror stories about people blowing out trading accounts and losing more than they actually had in their account. It's a reality to trading futures. That's why it's so important that people trade within their boundaries. You should have boundaries on yourselves. We have daily loss limits, weekly loss limits here, because all too often you do hear about or see or just know that it's happening. Someone goes out there, puts $20,000 in a futures trading account, and might be gone in a matter of a week, 2 weeks, 3 weeks, a month. It can go very, very fast, and it's a tough business too. But if you play your cards right, manage your risk, which is they call it trading, but you're really here managing your money, managing your risk. That's the name of the game, the name of the business.
Yeah, well, here's where we get into the full transparency part of it. Any product that you trade is going to be very, very difficult to trade profitably. Nothing's easy about any of them. We're just specifically talking about some of the advantages of futures. And just because one of the advantages is leverage doesn't mean that you even need all that leverage. Like, just because you have $1,000 in account and, maybe you want more leverage than stocks will give you. But I would highly encourage people not to try and go for the most leverage you can on anything, because once again, your margin for error, hence the name margin account, becomes very, 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 very small. And when you're walking on that razor edge, you could be right, but not before you're blown out.
Mm-hmm.
Great point.
So, yeah, I like leverage is a tool, just like anything else. It shouldn't be the end all be all. People just will levitate the things because it has the most leverage. Sometimes you just want the right amount of leverage for what you're trying to do and the size of your account.
Right.
And that's, oh, I'm sorry, Dan, go ahead.
No, go ahead.
I was just going to say, that's why stocks are more appealing to some people. What your maximum risk threshold is. And obviously with futures, more leverage equals more risks. Brokers are trying to make stocks more appealing. They're offering zero commission trades, and you can buy fractional shares now. They're really offering some low risk ways to participate. But at the same time, if you need that action and instant gratification, then futures are definitely your best bet.
What is the most leverage? We can go around here. What is the most leverage that you guys, as sort of a rule of thumb, would use in accounts? Like based on your account size. I really haven't even thought about this that much as far as a number. It's something I kind of think of intuitively. But, say you had a $5,000 account. How big are you trading in that?
One contract. Max.
Jinx.
Everybody pay attention to that. Say you had a $10,000 contract. Or sorry, $10,000 account.
I'm still having a hard time going more than one.
How big an account would you need before you were to trade a 10 lot of futures?
That's a good question. I don't want to answer that question based off of what your account size is, because could have a $20,000 account and then someone else could have a $20,000 account. We could treat it very, very differently. I may say, hey, even with the $20,000 account, I shouldn't be losing more than $500 a day. Whereas the other person might say, oh, I could lose $5,000 a day, which is an extreme, but there are people out there where that's just a huge percentage. So I think you should really be basing your contract size not so much off of what you have in your account, but your plan. It's always best to be nimble. You don't ever want to have your back against the wall and feel like you have too much leverage on. But I really think, it's got to be based on yourself. And even with a large account like 20,000, which, relatively, it might not be that large of an account, but you have to think about what percentage of your account you could risk on a daily basis. And I think that's more important than contract size.
It depends on the product you're trading. Obviously, I was using that more as a thought exercise to kind of illustrate what I think we see to be one of the biggest problems people have in accounts is we answered one contract right away for those. And I think the way we see people blow out a lot is by trading a lot more than one contract in an account size like that.
Right. For me, I keep my account. I try not to keep too much money in the account because just like every human being out there, when it starts to go against you, you start to wonder, okay, how much do I have? How much risk can I handle right now? And if that account looks a little bigger than normal, you're willing to take that subconscious risk.
Guilty.
That's right. We've all
Early
done it.
on, definitely.
We want to take that chance, and I totally get it. For me, it's keeping that account balanced to a number that it's not going to allow me to take too much risk. And if I blow out an account, I haven't blown out everything. So I try and keep my account to a normal size. For me to start to size up, first off, I got to be having a really good week, and I've got to be having a really good trade and a good day. And I'm in on a trade right now that's starting to go in my favor, and I'll start to layer into that trade. I'm really happy with the specific level. It's paying out really nicely. All right, I'm going to take another one as I hit this level. Starts to go, okay, my next level, I'll take another one on a little bit of a pullback here, and I'll build into it. But for me to slap a 10 lot on out of nowhere, unless I was with the prop firm, there's not a chance. That's my money. I'm risking it. I do not want to just throw on a 10 lot all at once. For me, it's building into that before. And I can't remember the last time I was up to 10 contracts. It's been a long time.
Yeah, it's difficult to trade your own money that way, and that's why, just more advice out there that you got to treat your account like you are your own prop firm. And that's part of the reason, since leaving the prop firms I was at, I don't trade the same way at all, and frankly I don't do that much day trading anymore. I do more longer term things, but that's because it's very difficult to sort of trade and your own money and manage the risk that way.
Before we leave the topic, when we're talking about position sizing, I want to mention one thing that we didn't bring up yet, is what is the market environment that you're trading in? A couple months ago in equities, we were seeing huge daily swings. Someone who might be a 50 lot trader, they're not going to be trading 50 contracts during that type of movement. They're going to be scaling it back. Some of the better traders out there, they always trade smaller than they can. I remember when not long after I started trading, crude oil was on its way up to $145 plus, and we were seeing almost $30 price swings in that product. And I remember talking to an old boss of mine about the market, and he said, you need 200 grand in your account to trade a one lot in that market. And I don't really think he was exaggerating there. You get a $20 move on that, and it's a big percentage of a $200,000 account there. So market environment's big. If you're watching corn during a slow time of the year and there's a 4-cent range in corn, maybe you're trading a little bit bigger because the range is smaller, the volatility is smaller. But you've got to adjust on the market environment.
Well,
yeah, good point.
That's a great point. And I'll kind of bring it back in, and I'll attempt in my mind right now to try and encapsulate what we've discussed as far as futures go. Is that they're a great product for giving you the leverage and exposure you want as a day trader. And those are the tools. They can be used for good or evil, as we say. You can make a lot or lose a lot. But I think that's what we get at. I think they're the most direct way to get the exposure you want to day moves at the leverage you want. And you can tailor it that way. So does anyone have anything else to add to that before we get inspired?
Do we want to talk about leveraged ETFs at all in comparison to futures by chance? Or should we save that for another?
I think that we can. That's a whole other can of worms that we can talk about.
Why I asked. I think so too.
Let's do a whole episode on it sometime.
Yeah, that'd be fun.
We talked to Will Ryan from Granite Shares about ETFs, which was a great podcast. And I'm super fascinated. I never really traded those leverage ETFs. I understand some of the mechanics of how they work. They're interesting. So I think maybe we save that.
Let's do it.
Sounds good.
All right. Well, Dan, do you have a quote for us? Or
I do. I like this one a lot. It's from Ed Sakota. If you cannot take a small loss, sooner or later, you're going to take the mother of all losses. Thought it was as simple as it gets, yet as true as it gets.
That's the way to do it. All right, guys. Well, thanks for stopping by for Coach's Playbook. Be sure to check out the Tesla Trader blog. Check out the Limit Up podcast. I think just Dan and I are going to be talking this week. And we'll go into, you've been making some decent trades lately. So we're going to kind of dissect those and see the way that you're thinking about them. And for everyone else, there's no Hogue here. So who wants to sign us off?
Do we have a quote?
We did. It was Ed Sakota.
Oh, sorry.
after this is when you just blame it on a Zoom connection and move on.
Yeah.
All right, guys, have a wonderful week. We'll be back next week with a brand new topic, maybe leverage ETFs. Take advantage of these markets. They're moving, manage your risk, and trade well.